Hello, everybody. It's Denny here. Eric over in California in Malibu. Is it nice and sunny by you, Eric?
It's actually kind of cloudy and eerie for the past couple of weeks, which is
Oh,
not very LA. But yeah, fits the season, I suppose.
good. Well, we got. I say good because we got the same kind of weather here, so I don't have to be jealous. We got also kind of overcast. Um, Lots to talk about. I was on Bloomberg surveillance earlier this morning, and Jonathan Farrow asked me whether our none and done prediction for the what the Fed will do with the Fed funds rate for the rest of the year, whether that was totally a response to the payroll employment number. And the answer is that was part of the reason, but we also noticed that the purchasing managers survey for non-manufacturing was extremely strong. Initial claims remain extremely low. And then, of course, I guess about a week ago or so, we had the upward revision in gross national income. So a lot of the pessimists who said that that weakness in gross national income was likely to pull down or lead to downward revisions in GDP, well, that got completely turned around. And instead of a downward revision in GDP, we had a slight upward revision. And meanwhile, the gross national income was revised higher, as was personal income, as was the savings rate. So this notion that consumers were running out of excess savings and the savings rate was too low, couldn't go any lower. Therefore, consumers would have to retrench. That scenario kind of blew up, as did I think, the recession scenario that has been dogging us, dogging the markets for about 2.5 years now. I think that was put to bed on Friday when the payroll employment number was very, very strong, and there were upward revisions in the payroll numbers. So that's all good. The economy looks to be in good shape. Eric, you want to add any thoughts on some of that?
No, I mean, I think it's the same stuff we've been highlighting for the past few weeks,
Right.
all coming into focus.
Yeah, and I think the none and done scenario. Again, we got a call from Bloomberg on Friday, and the reporter Lou Wang uh, was said that our none and done was a contrary prediction, that the consensus was that there would be maybe two more cuts of 25 basis points even after the payroll numbers came out. But we were thinking that 50 was too much. 25 was as much as we thought was necessary. We didn't even think 25 was necessary. I think with the benefit of hindsight, with the data we have, it does raise the question of whether 50 was necessary and whether 25, even 25 might have been necessary. But look, what's done is done. The Fed did 50. I suspect that they have some regrets about being that aggressive. On the other hand, they can tell themselves they kind of got to where they needed to be relative to the data that's out so far. And there's, as a result of that, there might not be uh, a rate cut of 25 basis points, certainly not 50 basis points at either the November meeting or the December meeting. As a matter of fact, Eric and I put together a list of a dozen reasons. There's something, even dozen. There's something that rings about that notion. So we did, without actually having to come up with too many kind of wild ideas. We did come up with, we think, 12 reasonable reasons why the Fed shouldn't lower rates, and certainly, at least not immediately, and not again. And certainly one of them is that the economy is performing better than expected. We seem to be in sync with Governor Bowman. You want to give us a little wrap up of what Bowman's been saying of late?
Yeah, I mean it. It almost reads. Her speeches read very similarly to what we write. that it's really hard to tell what impact immigration's having on the labor market, and things look to be normalizing rather than deteriorating. Still a pretty strong labor market, and unemployment's pretty low. And Bowman notes that productivity gains have been big supporters of real wages and economic growth, and also putting downward pressure on inflation in the economy. So I think things look pretty good. And I think to Ed's point about if they don't cut in November, the SEP kind of suggested a lot more Fed officials were in favor of just 25 basis points.
That's the that's a summary of economic projections
Yeah.
that came out in September.
So if you think about it, if you favored 25 last meeting and potentially, I guess, 25 in the November meeting, you're already kind of there with 50 basis points and then a lot of stronger data since. So it's very reasonable that those officials have a little more credibility in the upcoming meeting and they kind of just stand pat.
Yeah, well, also Bowman said that we're really not there yet. We're close to 2%, but close, but no cigar is not something that she's in favor of. I mean, clearly, from a forecasting perspective, we've been arguing for a while that we get down to 2% by the end of this year. So we're perfectly happy with that. But the Fed's job isn't to say we're almost there. They have to have conviction that they are there. And there's still an issue with the super core inflation. We didn't raise that issue. Jerome Powell raised that issue back in, I think, November 2022. He gave a speech at the Brookings Institution. Was it? Do you remember if it was 2022 or 2023 offhand? Or we'll have to. Yeah, I don't either. But time flies when you're having this much fun. But it was Powell who brought up the idea of a super core inflation rate, which is the CPI. Actually, it's the consumption deflator services, excluding energy and excluding rent. And that's been kind of sticky, above 3% of late. And yet he doesn't mention it anymore because now, since Jackson Hole, his focus has been on keeping the unemployment rate from going up. And wouldn't you know it, it got up to 4.3% a couple of months ago, and then on Friday it was back down to 4.1%. So the economy doesn't, the data doesn't really support what the Fed did, but they did what they did. And as Eric said, quite a few of them wanted to do 25, not 50, and then they thought maybe another 25. So they're already ahead of their game as far as they're concerned. What else? Well, when it comes to the no landings, the no landing scenario, in addition to that, the Fed should, I think, give some weight to the fact that there's an election coming up here. They say they're not political, which is fine. They say that they just focus on, they stay in their lane. They just focus on monetary policy. But they do have an econometric model in-house that they run on a regular basis. And it certainly has to have some fiscal sector in it, some fiscal variables in it. And so there's a lot of uncertainty about who the next president will be. And there's not much uncertainty about what the result will be either way about the deficit. It looks like it's going to be bigger. And it looks like the fiscal policy will continue to lean on the inflationary side. So it's a little premature for the Fed to say they're giving basically more weight to the unemployment rate. I know they said that they're balanced, but in terms of Powell's language, it certainly sounded like they weren't balanced at all, that they were much less concerned about inflation and much more concerned about bringing the unemployment rate down. And then there's the Middle East situation, which has certainly been getting worse and worse. Today is the horrible anniversary of that horrible event that occurred a year ago when Hamas attacked Israel and murdered innocent civilians. And here we got the price of oil finally responding to what's going on, the escalation of the conflict, as everybody waits to see how Israel will retaliate against Iran. And then, of course, Iran will come back and they'll announce that now they have to retaliate against Israel. But that's clearly got the attention of the oil market. Oil prices have, in fact, been going up. And oh, by the way, and also on a global basis, the Chinese government decided to stimulate their economy after all. And as a result of that, commodity prices have been moving up. I think oil may be benefiting from Chinese stimulus as well. But it certainly looks as though we've got a combination of the Fed being quite stimulative with the 50 basis point cut, with the Chinese government saying they're going to do whatever it takes to stimulate their economy. By the way, on a side note, we're still kind of skeptical whether that's going to be whether it's going to work or not. Basically thinking that the underlying geriatric demographic profile combined with the totalitarian aspect of that regime. Eric, you forwarded me an interesting article about getting a passport or having a passport in China.
Yeah, I think the FT wrote it over the weekend that China's restricting passport access for teachers and government officials, ostensibly to prevent them from being quote unquote corrupted by foreign sources, but more likely to keep money in the economy. That doesn't really sound like that sounds like a panic measure rather than some sort of real stimulative measure for consumer spending. So that doesn't really like inspire confidence, I would say.
Well, the thing that struck me about the article is also what teachers are now prohibited from traveling abroad, and it just looks like the regime is becoming more paranoid. I know that bumper sticker says just because I'm paranoid doesn't mean they aren't out to get me. So maybe Z has some legitimate reasons for being paranoid, but he shouldn't. I mean, China's doing great. The economy has been doing fine until the Chinese Communist Party decided that they had enough of capitalism. It's capitalism that made China flourish, and now its central government, the Chinese Communist Party, is squashing that, and that's certainly not helping the economy over there. With regards to the bond market, I think we had a pretty good call. It was back in August, so we said get ready to short the bond market, and the idea was that I guess it was the July payroll report came out at the beginning of August, and then the August payroll report came out at the beginning of September, and both of them were weak. The July report we attributed to weather, and the September report we suggested maybe the problem is a shortage of skilled workers, and that was confirmed by the National Federation of Independent Businesses. But we felt that that was kind of a soft patch that would pass and that the economy would improve. And as a result of that, we thought that the Citigroup Economic Surprise Index would be moving higher. And that's an awfully good indicator of the direction, at least on a short-term basis, of the bond market. And we did think we'd get to 4.25%. And so here we are this morning at 4%. Oil prices are higher, and that's unnerved the stock market somewhat. What's unnerving us is everybody's getting more bullish. We saw Goldman is talking about 6,000. So, we at the beginning of the year used 5,400, and we thought that was kind of out there. And when we got there a few months ago, we went for 5,800. And I don't know, we don't really feel like chasing all these 6,000ers around. I think the valuation multiple is going to kind of stay here for a while, and the market will go higher in earnings. And we do think earnings will make a record high in the third quarter. So it's still a bull market. We think that it broadens out, maybe not so much to Russell 2000 and the mid caps as much as people thought, and more to the S&P 493. In other words, instead of a lot of money going to Magnificent Seven, now more of it goes to the rest of the S&P 500. Eric, unless you want to add something, I'm going to go into the charts. All right.
Yep, go for it.
Okay. So here we go. So October 7th, chart collection, morning briefing. Eric, give us a quick rundown on how the perceptions of what the Fed's going to do have changed since the 50 basis point cut in the Fed funds rate, and now, of course, since Friday and the payroll employment report.
Yeah, I mean, you can see that's immediately thereafter from the 50 basis point cut, expecting 10 quarter point cuts over the next year. The market basically priced in the Fed would cut all the way to the terminal rate, or like the ultimate endpoint of an easing cycle. So all the way to 2.8% just in the next 12 months. That's a pretty extreme pace of monetary policy and easing, especially for one that doesn't foresee a recession. And that's kind of come off a lot just in the past few weeks. So as longer term yields have risen, so have like the expectations for rate cuts weakened. So over the next 12 months, the market's now pricing us getting to 3.5% on the Fed funds rate. Again, that's fairly aggressive easing, but I think the delta is what's really notable here, just in a few weeks' time.
Yeah, I mean, the concept that we continue to kind of question is this neutral interest rate, that there's some nirvana level of the federal funds rate that if the Fed gets us there, we'll be in nirvana. We'll have the economy growing and it'll grow. Well, nirvana at the Fed is 1.8% real GDP growth. I don't know what planet they're on, but the real GDP has been growing more like 3%. It seems like they're really not doing much to factor in productivity. And that's not a forecast. Productivity has been doing quite well. But in their nirvana, the economy is growing 1.8% real GDP, and inflation's 2%. And they think that the long run Fed funds rate that they need to get to achieve that nirvana is 2.9%. Now think about it: 2.9% is the nominal nirvana rate, neutral rate. Take out the 2% inflation rate, and they're actually thinking that the real Fed funds rate is 0.9%. What can we say? I mean, we don't even understand what a real Fed funds rate means. So, I mean, the Fed funds rate is an overnight rate, and it's being adjusted with a year-over-year percent change in the inflation rate. Do you know of anybody in the economy on the planet that makes important economic decisions based on the real Fed funds rate? Maybe the nominal Fed funds rate, maybe the nominal bond yield, or even the real bond yield. But this idea that the real Fed funds rate in nirvana is 0.9 just doesn't make sense. And we're thinking that the nirvana rate might be more like 2%. If it's 2%, then add 2% inflation and you get 4%, which is where the bond yield is. And it certainly doesn't get you the Fed funds rate down to 2.9%. At the end of the day, again, this is just a fairy tale, this neutral rate. I think the best the Fed can really do is try to assess whether they're there yet. So I would say that the Fed funds rate that we've had for almost a year now, prior to the cut by 50 basis points, that looked like the nirvana rate. The economy was doing fine. That's been confirmed by the latest payroll numbers, by the latest purchasing managers non-manufacturing survey, by the upward revision in gross domestic income, and with the reality that the productivity numbers have been really good and probably will be revised upwards. And now, again, we don't want to get too cocky here and tell you that there's not going to be a recession at all. I think I'm not sure there's any hardlanders left. Eric, I saw a couple of them still on social media claiming that maybe there's something wrong with the data, or that the data that came out on payrolls didn't add up with the employment numbers for the MPMI and NMPMI. You want to kind of just weigh in on that one? Should we be concerned that the NMPMI and the PMI employment indexes just are kind of weak?
Yeah, I mean, first principles, hard data over soft data. But the manufacturing PMI employment data has been very weak, and granted, manufacturing employment hasn't been all that great. But if you look at actual services employment gains month over month and what's suggested by the ISM services PMIs, they're completely decoupled over the past couple of years. So survey data has been particularly weak, but the hard data has been very strong for several years. So, you got to
just jump in there and just also kind of flush, give us a little bit more on that with the MPMI. A lot of people have been freaked out that the MPMI has been running on under 50 for quite some time. Just kind of review for us why we're not as freaked out about that.
Yeah, I mean, first of all, the economy is much more services oriented on both consumption and output. It's about 2 to 1 services to goods. So, the manufacturing sector is about 8% of private employment. That's not, a meaningful chunk of the economy. It's certainly not the 1/3 that it used to be several decades ago. And surveys have been very weak post pandemic for whether it's partisanship or just some sort of weak response rates across surveys, or the fact that they're doing more online. Consumer sentiment, MPMIs, these have all been very weak. So it is what it is. I think the hard data is better, and I think the goods sector has been in kind of a rolling recession. Interest rates are much higher; they were jacked up pretty quickly. But that probably improves over the next few quarters as rates are lowered, or assuming rates are lowered somewhat.
Yeah, we even kind of questioned whether the MPMI gives you much of a insight into the goods economy. If you take the year-over-year percent change in real GDP for goods, it hasn't turned negative at all since the pandemic. As a matter of fact, it's up 2% currently on a year-over-year basis, and it used to correlate real tightly with the MPMI, but that's not happening anymore. So there's a bunch of misleading indicators out there that have just been, as a fact of life, been misleading. The MPMI, the index of leading economic indicators, being two of the standouts. But again, we don't want to get too cocky about this forecast of ours, which has worked out pretty well. The idea that there's no hard landing and maybe even no soft landing and just no landing, the economy is still doing just fine. But we are keeping an eye out in the Middle East. The oil price spikes up because of the next level of escalation between Israel and Iran really gets increasingly out of hand. It's already out of hand, but it gets even worse. And then that would be something that would take us back to the 1970s kind of analogy. But we're not there. We just think there's plenty of oil around, and we don't think it's going to get to that point. But we're watching it, as you can see also in this chart. The labor market, what can we say? The numbers were great on Friday for September, and this is one of Powell's favorite charts when he talked about the way he looks at the labor market about a year or two ago. He said that he looks at it this way. He looks at the supply of workers as being the labor force, and the demand as being household employment plus job openings. Eric, we got to talk about this a little bit because household employment is the number of people with jobs, whether it's part-time or not. And here he's adding it to job openings, which could include part-time jobs. There's a little discontinuity there, but it's a good looking chart that kind of shows that, we had too much demand for labor relative to supply. Now they're more in equilibrium. And so our position is, so it's normalized. Why freak out about it being cooling off and then freezing? That's just not happening. And there's fewer jobs, but there's still a ratio of about 1 between job openings and the number of people unemployed. And at least for the history of the data that's available through 2002, that's a pretty good labor market. We had a few comments we made on the labor force. Labor force has risen to an all-time record high. This is the supply of workers. You can see that if you take out foreign-born, we really haven't had much growth at all in the labor force. So a lot of this is foreign-born, and how much of that is even accurate? We don't really have a really good clue on how much of the labor force increase is illegal aliens and how that might be affecting the statistics. We think it is affecting some competition for jobs at the lower end of skills. So younger kids seem to have a higher unemployment rate than they have in quite some time. So maybe they're running into more competition from that incoming population. Meanwhile, if you're looking for something on the negative side, there wasn't much, but this very volatile series, average weekly hours, declined a bit. That probably means it's going to go up next month, but it declined 0.3%. As a result of that, even though payrolls were up quite a bit, aggregate hours worked was down 0.1%. It zigs and zags a lot, but it's zigging and zagging into higher and higher record highs. So we're not concerned about that at all. And our Nobel Prize winning earned income proxy, I'm just kidding. We're not going to win the Nobel Prize for it. But this is a very useful indicator that we put together every time the employment numbers come out, showing the average work week, the number of people working, and then wages. Wages were up 0.4%, which is a pretty good increase, especially in the past month or two when inflation has been kind of like zero. So that's a real increase in wages. And so you can see nominal earned income proxy has been doing quite well and suggests that all these measures of consumption, retail sales, consumption of goods, and so on should continue to move to new highs. This is what we mentioned before. It's not just the employment number that was strong. We also had a very strong purchasing managers index for services, and you can see that the new orders component was almost up to 60. Same thing for production. So those were really strong numbers for September. And then the Citigroup Economic Surprise Index, we view that as a soft patch. Looks like we're getting confirmation of that now with it turning upwards. So we did think that, we weren't going to go kind of straight down to 3%, which was kind of the thinking during the summer about how fast the Fed would have to lower interest rates and how fast they might fall. And now we're seeing them moving back up to 4%. I think the 2-year and the 10-year up at 3.99 or 4% this morning. So look, as I said, we have really no problems with the market now being earnings driven increasingly, maybe with a backup in rates. There's less upside in valuation multiples, which is fine with us since the Buffett ratio is already at a record high and the forward PE is not at a record high, but it's quite elevated. Eric, why don't I get rid of the charts? Why don't you take us through a couple of questions?
Yeah. So first one from Scott. Seems to be a higher than normal amount of government jobs in the last 9 months. Seems unsustainable. What are your thoughts?
Well, some of that may very well be related to the flood of illegal immigration and the workers that are being hired to deal with that. But there's been lots of strength in other areas of the labor market, leisure and hospitality, healthcare, financial services. So that doesn't really stick out as a major issue. That the government's doing all the hiring, and that once we get past the elections, that'll all kind of fade away.
This one's from Cagdis. Hi, Ed. Great calls lately. If you end up being right on your none and done call, don't you think that could turn out to be somewhat bearish for the stock market into year end from current levels? And what does it do to your 30% probability of a melt up?
I think it broadens the market. Maybe the Magnificent Seven take a pause here for a while, and you see more money going into the less magnificent 493 members of the S&P 500. Maybe some of the money that thought that it would go into the Russell 2000 that stays in the S&P 500. So we're sticking with 5,800 through year end. We've been thinking that if this market just kind of jumps up to 6,000 and higher than that, then we're basically talking about our melt-up scenario, which, after the Fed lowered the Fed funds rate by 50 basis points, we raised the odds of a melt-up scenario, the kind of 1990s party all over again, from 20% to 30%. So we're not dismissing the potential for a melt-up, but we think in our roaring 2020s scenario, 50% probability that 5,800 kind of feels right to us for a while here. So, if it gets to 6,000, maybe it's at that point that you'll have the market correcting somewhat. And again, it does feel as though a lot of strategists are turning more bullish. So our contra instincts are coming out a little bit.
Okay, I think we can fit two more. This one's a quick one. Explain how productivity is calculated and measured. Generally, it's just output over hours worked. Do you have anything to add?
Eric, yeah, that's a short question, but the answer is long, so we won't get into it. But yeah, productivity is output divided by hours worked, and the output is basically real GDP. It's called gross domestic product for the non-farm business sector. So it's non-farm business. And so the upward revision in real GDP is going to lead to an upward revision in the output measure of productivity. And meanwhile, the hours worked is all over the place, right? Eric, the employment numbers suggest the hours worked are up, but the average work week shows that the aggregate hours were down in September. And then there's that annoying heads up about, a year from now, the Bureau of Labor Statistics is going to maybe revise the employment data down by 800,000. If that's the case, then real GDP is revised up. The productivity number boom that we've been talking about is not just on course, but it might actually be ahead of schedule because year over year productivity growth now is what it's
2.7.
2.7, and based on what we have so far, it could be revised up to 2.93%. And if we ever get a situation where they actually a year from now revise down the official numbers by 800,000, we'll be looking at something north of 3.5%. Let's do one more, Eric.
Yeah, I'm gonna skip to the bottom. Gus says the increase in the population's running around 1.5%, whereas productivity is around 2.5 to 3%. So should we expect potential GDP to be around 4 to 5% moving forward?
I like that kind of thinking. That's kind of what Eric and I are thinking, is that the surprises are likely to be on the upside. The productivity just doesn't seems to be the Rodney Dangerfield of economic variables. It gets no respect. I mean, you don't see people talking about it, maybe because it's quarterly and because it does tend to get revised. But we think it's very important. Not only that, the unit labor costs, which doesn't get talked about much, that's up 0.3%, and that could very well be revised into being slightly down. And unit labor costs is kind of the key driver of labor cost inflation, which then drives overall inflation. So yeah, that's the roaring 2020 scenarios, that the surprises are going to be on the productivity. And if productivity is better than expected, then it's a whole litany of fairy tale kind of stuff. Real GDP is better, inflation is lower, real wages go up, and profit margins continue to improve. Did I miss anything, Eric?
No, I think that covers it. And with that, we're
Okay.
kind of over time.
Okay. Eric, thanks for joining me. Thank you all for joining us, and we'll see you next week.
Thanks, everyone. Have a good week.
Bye-bye.